From semiconductors to software, cloud platforms to artificial intelligence, technology isn't just reshaping industries, it is reshaping portfolios. And for the past decade, tech has not just been a sector, it's been the driver of wealth creation. Now, if you track the S&P 500, which accounts for nearly 60% of global listed equities, more than 2/3 of the value created over the past 10 years has come from technology companies. But we're also at a moment of profound uncertainty. Inflation, sticky interest rates and geopolitical tensions are putting pressure on markets. Valuations in the United States remain elevated, leading some to ask, are we in a bubble, particularly with the hype around artificial intelligence? Hello, this is No Ordinary Wednesday. It's an Investec Focus radio podcast where we take a deep and considered look at the forces shaping business, economies and markets. I'm Jeremy Maggs. Today, I'm joined by Investec Investment Management's Global Equity Research Analysts from the United Kingdom, Zane Bezuidenhout and Dave Smith. And between them, they cover the full tech spectrum. Semiconductors, software, hardware, and also platforms. They've just returned from the Deutsche Bank Tech Conference in California, where they met with some of the world's most important companies. And they're going to help us unpack why tech still matters, what's hype and what is real, and where investors should be paying attention. Zane, Dave, welcome back to No Ordinary Wednesday. Dave, let's start with the big picture if we can. If valuations are as stretched as some critics are suggesting, I've got to ask you why tech deserves attention today. Where's your head?
Jeremy, it's a good question. There's probably 3 key points. One is tech is actually just too big to ignore. 2015, go back 10 years, in the S&P, which is the major index most people are going to be investing in on a global basis, it was 7% of the S&P was tech. It's 48% today. You literally can't invest in global businesses unless you're willing to take some exposure to tech. So that's the first point. The second is most of the value creation in the last 10 years, global equities, has come from tech. The work that Zane and I have done suggests 2/3 of the value in the last 10 years has come directly from tech-related stocks. And then the third point would be there are some of the best business models in the world that you can be exposed to. And not everything's expensive.
Basically, what you're saying is it's the size, which I absolutely understand. So, Zane, from your coverage of the tech space then, what I wonder makes these businesses fundamentally different from other industries?
Thank you, Jeremy. As Dave alluded, I mean, these are some of the best businesses and best business models in the world that, typically, although maybe one would argue not so much recently, given the investments they're making, but they are typically asset-light businesses. Their growth is driven by innovation, research, and development. So they are rich in intellectual property and asset-light businesses, and they grow at incredible rates with this innovation that they generate. They typically also benefit from strong competitive advantages, scale economies that we've spoken about, strong network effects in some cases, and then my personal favorite of competitive advantages is high switching costs, so these are fantastic business models and that's why we love them so much.
So talking about fantastic business models, let's focus on the hyperscalers. So we're talking about the likes of Microsoft, Amazon, Meta, Google. They create, and this is staggering, more operating profit combined than the whole of South Africa's GDP. That's almost worth repeating. Google alone generates revenue greater than South Africa's entire GDP. That's a staggering comparison. Dave, what does this tell us about the scale and the dominance of these businesses?
Good question. So there's probably 2 key parts to it. One is to what Zane alluded to. Scale economies come through. The bigger these businesses come, the higher their margins are, the more cash they generate, the more that they can reinvest back into their own businesses, and the bigger the moat around their business, right? So that's probably the one. The other is tech tends to lean itself towards when it takes most. A great example would be Google search. In search, Google has 90% of online search market. So what you have is when you find the winner, they tend to take the lion's share of the profit and they tend to have really big moats.
So Zane, let's get into artificial intelligence. Obviously, we need to go there. It's the next great platform shift following the evolution, I guess, of mainframe PCs, the internet and mobile. So from your perspective, where are we on that journey right now? And perhaps more importantly for our audience, how do investors need to start thinking about this new paradigm, this new era?
Yes, and it is very much a platform shift. So maybe starting with the latter, it's how investors need to think about it. This is a structural change, and it's a structural change in the way we do computing. And this was the ChatGPT moment. Ultimately, what it showed was that accelerated computing, as opposed to general purpose computing, and to break that down, basically accelerated computing is like parallel mathematics, where general purpose computing is more linear mathematics. So the way we compute is going to change. And with artificial intelligence, it's going to require more compute. So there's more and it's different. And that is the direction that we're heading. And it's a big structural shift as we went through the previous evolutions that you alluded to. In terms of where we are in that shift and the companies that we've spoken to in our conference in California that we attended and the calls that we listened to, very early innings. Yes, it feels like the rapid rise over the last 3 years that this might be long in the tooth, but a lot of these companies are saying that their supply cannot meet the demand from an AI perspective and that there's still the supply gap from their side. So it seems like we're still in the early innings of particularly the infrastructure rollout behind artificial intelligence.
But Dave, having said that, there's always risk on the horizon in one way or another. You've just returned from the Deutsche Bank Tech Conference in California. Are companies that you engaged with, observed, maybe a little bit more optimistic than fearful about an AI bubble? Do you hear anything that makes you confident that this isn't a repeat of the dark days of 1999, I think it was? Yeah,
that's about right. So Microsoft's a great example in that case. 1999, Microsoft traded at a 65 times forward PE. It's 30-ish today. It's half of where we are. We're not saying that there couldn't be some areas that might be worrying in times to come. But where we are today, as Zane's point is, there's a lot of compute that is needed, that the supply cannot be fulfilled right now. It's going to take some time. If you talk to me in 18 months, 2 years, I think the conversation could change. But importantly, the kind of businesses we like to invest in, actually their multiples are really cheap. Example is of the Mag 7, the ones that we like and we're overweight. It's not all of them. The average multiple is 25 times forward for great companies generating huge cash flow, and we really like they're growing fast.
Let's talk about tariffs again in terms of risk. For investors, what's the feeling? What's the perception on the ground? Is it a short-term noise factor or maybe a longer-term shift in how the tech companies are valued? Zane, pick it up. Dave, you might have a view on it.
Yeah, it's actually an interesting point. I mean, when we go to these conferences, not only do we listen to what's said by these companies, but also what's not said. And tariffs were hardly mentioned at this tech conference. This tech conference, yes, it was more skewed to semiconductor companies in the semiconductor value chain. But I think what's maybe more relevant for them, less so as tariffs, but is more around export controls and restrictions. And we know that there are geopolitical tensions or competitiveness, particularly between the US and China, and a fearfulness of allowing one to access advanced technologies and how those would then be used by, their competitor. So although those weren't explicitly discussed, we know from public markets that a lot of these companies have reduced their guidance to investors of what they can expect from China, just given these export controls and restrictions.
Dave, you also cover some companies in the robotics space. How long is it going to be, or how close are we to seeing robotics as a genuine investable theme beyond just, the hyped headlines and maybe even the science fiction?
So I'm quite optimistic longer term. Yeah. I think it might be one of the solves for demographic issues, particularly in places like Europe. But we're probably minimum 5, probably closer to 15 years away from a humanoid robot walking around your house doing the dishes and cleaning the floor.
But from your lips, my friend.
But what's interesting is there are actually robotics companies you can invest in. Tends to be in medical areas. You can have a robot in one country. You can be a surgeon in another, do a surgery. There's a whole bunch on warehousing where they're automating warehousing. There's a great company that does some of that. And you could even argue to some extent autonomous vehicles. You could argue are robotics companies, and that's coming fast. If you go to China, or if you go to the US, you go to California, you can get an Uber which doesn't have a driver in it. It's quite exciting.
So before we continue this conversation, I would like to take just a moment to tell you about something which is really close to Investec's heart, and that is Promaths. Promaths is a national program that helps high school learners master maths and science, two subjects that can change the course of a life. It began back in 2005 in Dobsonville in Soweto with the Kutlwanong Center for Maths, Science and Technology, and it's now grown to 19 centers nationwide, 10 of which are funded by Investec. This year we celebrate 20 years of Promaths, and the scale of its impact truly is remarkable. 6% of all South Africa's maths and science distinctions in 2024 coming from Promaths students. The program has reached more than 28,000 learners who've earned over 13,000 distinctions, and many of them have gone on to become engineers, doctors, and scientists. Now, education isn't charity, it's an investment in South Africa's future, and you can be part of it. From just 100 Rand, you can support the Promaths Bursary Fund, helping top Promaths learners get to university. Or if you're part of a business, consider helping fund a Promaths center in your community. Head to investec.com/Promaths. You'll find the link in the show notes, because every child who masters maths or science becomes more than a student. They become a problem solver and a nation builder. So let's help turn potential into purpose. And now let's get back to our discussion on No Ordinary Wednesday. Zane, back to you. Last year, we saw a global scramble over the semiconductor shortages. Are you able to give us a sense of how that supply crunch is easing, and then again draw the thread or pull the thread? What does that mean for investors?
Yeah, so I think it's worthwhile casting our minds back to COVID and those dark days of lockdowns where that disrupted global supply chains for every industry around the world, and semiconductors were one of the industries impacted by those shutdowns. So we went through COVID where there was this supply crunch that people just, semiconductors go into everything that we use. I mean, it's the technology behind all technology, and you get different types of semiconductors, some smarter than others. Your kettle's got a semiconductor in it, for example. So naturally what these companies did, and in this industry and other industries, is built up inventory to meet that supply gap. And then, lockdowns ended, the global economies tried to get back to normal, and then we ended up actually with a supply glut. So what we see in the non-AI space is, a recovery or a market, a semiconductor market that's trying to right itself and recover. And we're seeing that recovery in different end markets taking different times. The personal computing and the electronics market doing all right in its recovery. Industrial end markets, also finding its bottom, recovering. Automotive still oversupplied ultimately. So, for investors outside of AI, you've really got to look at the end demand and its end industry, and ultimately it's about the demand supply matching.
Dave, can we talk a little bit about investment strategy? You can argue, I guess, that this is a stock picker's market at the moment. Are there specific characteristics that you look for in tech companies that justify the premium valuation?
Absolutely. So the risk with tech is always you overpay. You get bought into the dream and it never quite delivers. So what we tend to look for is businesses that have or are developing scale. So they have reach, they have client base that is large. We like moats, so they're not easily disrupted. We like high return on capital, or at least the trend towards high return on capital. And then there are themes we like. So we've talked about semiconductors and AI a lot. The implications of AI going online is that you and I are likely to do more online. So e-commerce is likely to become a bigger portion of people's baskets. We like that theme. We like cybersecurity. We like the right part of the semiconductor value chain. We know there's huge supply constraints on the AI side. So you're trying to try to find business with a scale, businesses with moats, and playing into themes where there's long-term compounding ability of top line and earnings.
So Zane, are there then parts of the tech universe that, in your opinion, are looking a little overheated right now?
Yes, I mean, a big part of our job is to worry about what could go wrong. And there are parts, particularly with the evolution of artificial intelligence, there are emerging pockets around, these core companies that do cause a little bit of worry, whether it's some of these neo-cloud businesses that are almost financed, not entirely, but a lot with leverage to almost take surplus capacity that the hyperscalers themselves can't provide. We're cautious of how private credit is getting into the space. And then also there are a lot of peripheral stocks that might be subject to speculative behavior, so-called meme stocks. So be cautious around certain vulnerabilities. And normally, when one starts to see excessive leverage going into a certain part of the market, that's where we get a little bit more cautious.
All right, so that's the broad strategy then. Let me ask you both, are there specific stocks that you're interested in?
Yes, in terms of my coverage, it's the obvious one. And maybe that's where people roll their eyes, and given its run that it's had is the likes of the world's largest company, NVIDIA. When you listen to Jensen Huang, the CEO, you understand what he's trying to build. He's not just selling a widget or an advanced widget. He's really trying to build an ecosystem. He views his company as an architecture firm, and the architecture firm on which all AI infrastructure is going to be built. So you can see he is trying to establish his company as the go-to infrastructure play. And then that's going to create high switching costs for those that use his products going forward, because they'll become entrenched with his hardware, his software, and all the peripheral services. So he's really wrapping his arms around the AI ecosystem. So we think that a company like NVIDIA has a lot of room to still go. Dave?
So slightly tangential to that, my view is that Microsoft and Amazon might have the best business models the world's seen, but they're both a little bit further down the S-curve of growth. There's still very strong growth, but they're businesses that are replicating, for example, Amazon, which are earlier stage. So one of my favorites is a company called Sea. They are a Southeast Asian diversified tech player. They are very early stage in monetizing the e-commerce business. They're half of that market. They have a dominant position. They're building banks on the back of that because they know the client, they know the sellers, they can lend money to them with very low debts, and they have a really profitable gaming business. So I think this is one of those stocks that could do very well over the long term.
Which segues perfectly into my next question. Do you think we underestimate then opportunities in Asia and Europe?
There are specific examples that we do. And the problem is that Zane mentioned it earlier. It is a bifurcated world. If you are a Chinese tech player, and the truth is there are two major tech hubs in the world. It's the US and it's China. The rest of the world doesn't really have big giants. Europe's got one or two, but not too many. They can't play in each other's ecosystems well because the politics doesn't really allow for it. So when you think of the world's top 10 biggest companies, 9 are tech companies. One is Saudi Aramco. So it's a very different beast. 8 of those are US. The other one is TSMC, which basically produces the semiconductors that go into the US guys. So the reason why the US is likely to have the biggest long-term winners at scale, there might be specific examples like C, is they've got scale. Once you succeed in the US, you have enough revenue to be able to build moats and reinvest and take over the rest. Do the similar thing in the rest of the world. 2, they've got the talent. All the best engineers end up in the US, and they have the capital. People are willing to fund these early stage businesses. So they kind of have a competitive advantage in the global tech scene.
So, gentlemen, a fascinating and insightful conversation. Let's end with this then. And Zane, I'll come to you first. What's the single biggest misconception then that investors might have about the tech sector?
Yes, from my side, I would say the misconception is that AI is just hype and that the end is nigh. There have been a lot of popular commentary on how this is similar to the dot-com bubble. That's not what we see. While there's always pockets of caution, it's not what we see from our discussions with these companies and the analysis that we do. So we think that is a big misconception. We think the growth from these companies has been driven by strong fundamentals, and that we think the runway for further growth is long.
What about you, Dave?
That it's too expensive to invest in now, that the price isn't worth the earnings, or juice isn't worth the squeeze. I'll give you an example of Meta. Right? They're on Instagram, Facebook, WhatsApp. They traded at a 20 times forward PE. One of the South African champions, ShopRite, circa 17. But Meta produces a return on equity in the 40s and 50s. ShopRite's in the teens. Meta's long-term growth rate is higher. So I'd argue if you are a discerning investor, which hopefully we are, you will find some gems which are not overvalued and actually offer phenomenal long-term compounding for investors.
David Smith, Zane Bezuidenhout, thank you so much for joining us on this edition of No Ordinary Wednesday. Just before I bid you farewell, I do want to tell you that this episode has been filmed, so if you want to re-watch any parts of it, you can do so on Investec's YouTube channel. And as always, if you've enjoyed this conversation, please follow Investec Focus Radio SA wherever you get your podcasts, and we will be back in a fortnight with more analysis on the major economic trends that are shaping our market. Thank you so much.
Thank you for having us.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Limited and subsidiaries, authorized financial service providers, registered credit providers, and long-term insurer.